Welcome to a guide to understanding your homeowner's insurance coverage. I'm Ala Policastro, CLE advisor for the Beverly Hills Bar Association. Today, I am absolutely delighted to introduce our presenters, Linda Klamm and Alex Berline, who are partners at Hanson Bridgett, where they both focus their practices on representing insurance policyholders. I'm going to let them introduce themselves and their impressive backgrounds a little more fully to you today. And I just want to say that we're extremely grateful for their time and their willingness to share their expertise. Alex and Linda, over to you.
Hello, I'd just like to thank everybody for your kind attention. As Alice said, we represent policyholders in disputes with insurers, but both of us started our professional practice by representing insurance carriers. So we've seen both sides of handling claims and including handling homeowners and similar type claims. And in my case, in 1991, I had the misfortune of losing my home in the Oakland firestorm. So I've had both personal and professional experience dealing with these. We will be giving our presentation and we will be saving questions to the end because we think it's a more efficient way of handling this. First slide, please. In understanding your insurance policies, and whether you're now dealing with it after a tragedy of losing your home in a wildfire, or you're looking towards making sure you have adequate coverage, there are four basic coverages in your policy. One for the dwelling or the house, the other one for your other and personal structures like decks, gazebos, fencing, driveways, another one for personal property and contents, and another one for additional living expense, loss of use, when after you have a tragedy, you are out of your residence and have to reside elsewhere. Basically, the driver of your coverages is the coverage for your dwelling or house. Next slide, please. This is a typical, what they call a declaration page from on an insurance policy. Here you will see the coverage aid, the dwelling is $518,000. A coverage you will want, we'll discuss in more detail, is extended, sometimes called enhanced replacement costs. This gives you an additional sum of money in excess of your coverage aid dwelling limit in the event that your coverage aid dwelling limit is insufficient. And to be honest, when you go through a firestorm, it is likely to be insufficient. You want to extend it and enhance replacement costs. But when I said it was the driver, you will note that this limit is 25% of the coverage aid dwelling limit. And on policies, they can vary between 25, 50, 200,000, or 100%, sorry. Separate structures, traditionally, you'll see here it's 51.8, 10% of the coverage A dwelling limit. Then the coverage C personal property here is 388.5, which is 75% of the coverage A dwelling limit. Personal property can be anywhere, I've seen between 40, 50 is fairly common, 75, and sometimes even 100%. But again, they're usually done as percentages of the coverage A dwelling limit. And then your loss of use here is 40% of the coverage A dwelling limit. And it also gives you a term here of 24 months. We will discuss this more. Some policies only express a dollar limit. Some express a term limit here of 24 months. By statute in California, if you have a wildfire you automatically get 36 months, but that does not increase any dollar limit that you have for this coverage. It just extends it further. And next slide, please. One of the things you want to do is, what most of us, when we buy insurance coverage, we're looking at what is the premium. And what you need to find out is, how did they come up with the premium? And sometimes this can be very jarring. What is the square footage they use? Sometimes it's incorrect. Do they have the right number and types of rooms? Do they have the right type of construction? They may talk about wood siding when you have stucco. They may talk about a shake roof when you have tile. These are variations in what the cost would be to rebuild the home. And also the level of construction. You may be sitting there in a very high-end home only to see that it will say standard, which is kind of like a medium level, and is probably not appropriate. One of the reasons why this happens is obviously miscommunication. The agent may decide to pull up what is ever online description of your home. And unfortunately, agents are very competitive. They want your business. One way to do that is to reduce your premium. That may not be in your best interest, and they can do it several different ways, by either reducing the level of construction they're reporting, reducing the square footage. So it is important to go back and figure out what information your insurance carrier has in order to determine that they're using to determine your limits. Next slide, please. If you unfortunately suffer through a wildfire loss and you encounter the complete or partial destruction of your house, the very first thing you're going to want to do is get a complete copy of your policy. Unfortunately, in my case, I can print it offline. And you may or may not have facilities to do that through your insurance carrier. But when you tell your insurance agent you want a complete copy of the insurance policy, at least 50% of the time, what they're going to do is give you your most recent renewal declarations page and 3 or 4 other pages of newer endorsements that are likely not even relevant. So you need to be very firm that you want a complete copy of the policy, and that there will be a basic policy form so that somebody can look at it, you can look at it, and hopefully get there. In the event of a loss, the insurer will pay what actual cash value up to the stated limits on the policy. If we were to go back to my exemplar, the max they would pay for actual cash value for the house itself would be $518,000. Actual cash value is typically replacement cost of the house less depreciation for wear, tear, and obsolescence. Now, most of us realize that our houses increase in value over time, but what they are looking at is the cost of rebuilding your house and applying some sort of a depreciation factor for basically, you know, the the wear and tear that they figure the house it's 20 years old, so its actual cash value is less. Some policies provide for fair market value of the house, which is what a willing buyer would pay a willing seller. Next slide, please. The insurer will compute the actual cash value of your house. It can be disputed, but as a practical matter, in many instances, it will be equal to the stated limits. So there's no, frankly, point in disputing it. You're not going to get more than the stated limits for your dwelling at the time. If there's a mortgage, which is for most of us, the insurer will issue an actual cash value check jointly to you and the lender. And the lender will hold it until such time as you decide to rebuild or replace your house or opt to pay off your mortgage. Replacement costs for the house at the cost of replacing the house with materials of like kind and quality, up to the full replacement cost policy limits. And when I'm talking about that, it's your replacement cost limits on your policy, assuming you didn't buy a bare bones policy, you have replacement cost coverage. Any extended or enhanced replacement cost, and this, we went back previously, 120, another 25%. Coverage for code upgrades and coverage for other structures. Initially, your insurer will determine the replacement cost of the house, other structures, code upgrades, etc. If there is a dispute, which is not unusual, the insured then needs to go and obtain a competitive bid. And what can be very frustrating is that frequently the replacement cost will be determined by the insurer will retain a firm that provides cost estimates. They tend to come from states other than California. They do not build anything. They're not licensed to build anything. And their figures tend to be low. So if you're lucky, you won't have to go through this process, but many people do. Next slide, please. The policy language also states that the homeowner does not get paid the full replacement cost until the property is replaced. As a practical matter over time, this has been, despite the language in the policy, you do not have to fully complete rebuilding your home before you will get your full replacement cost. Most insurers, once you've exhausted the actual cash value funds in rebuilding the home, they will start doling out money for the additional replacement cost. This will be sort of a four-way partnership if you elect to rebuild, in that the insured, you will be dealing with your insurer, your mortgage company, and the contractor. Many contractors are very conversant in dealing with insurers on rebuilding or replacing homes, and they can take the lead on this. First of all, they know how to do it, and they want to get paid. So, next slide, please. And I'm turning this over to my partner, Alex.
Good morning, everyone. As introduced, I'm a partner with Linda in our insurance recovery group. Like Linda, I did the first few years of my career working on what I call the dark side for the insurance companies. But I've happily been representing exclusively policyholders for over 20 years now, which is much more rewarding, I can assure you. My family, we were evacuated from the fires, but thankfully didn't suffer any damage. But I live down here in Los Angeles, and I suspect many of you on the webinar today have been more dramatically affected. So the slide we have here, one of the things we're looking at is ordinance and law coverage. Many of the homes that were destroyed in the recent fires were quite old. some going back to the 30s, 40s, 50s. And not surprisingly, they're going to have technologies that are out of date, particularly electrical systems. If you're talking about apartment buildings, there may be requirements now for sprinklers, more advanced smoke detectors, etc. So this coverage grant within your policy is going to be specifically designed to handle those sorts of things. And it's important that if you are in the rebuilding process and getting bids from contractors, that you figure out what the various regulatory agencies are going to be requiring. I'm sure some of you have heard that the current rules of not allowing new gas appliances are going to be suspended for this emergency. So if you had a gas stove originally, you're going to be allowed to replace that. You don't have to do a new electrical appliance. So there's a lot of moving parts there, and these issues are evolving. I most recently heard Gavin Newsom talking about expediting the rules on fire-safe homes and having nothing flammable within 5 feet. I don't think that's been finalized, but they're sort of running out of time at this point. So anybody who's affected is going to need to monitor that issue on top of everything. Linda already spoke about the options that you have after a loss, rebuilding on another lot, or buying a replacement home. These may not be spelled out in any great detail in your policy, but it's actually California code, and we cite the code section here. So if you're considering those options and you don't see it in your policy, that's because it's codified. And the last item here, number 6, we have a number of clients, both in past fires and in the current fire, who maybe didn't suffer a complete loss, but they do have damage in terms of smoke, fire suppression, which is usually water. And some of the issues we've faced over the years is if you have a significant smoke or water loss claim, the insurer will typically point you in the direction of their preferred contractor. And some of them are good and some of them are not so good. I've unfortunately had a number of clients who, after the work was done, they still smell smoke, they still pick up their carpet and there's soot underneath. So I think if you have damage and you're about to get started, I would, at a minimum, interview a contractor, maybe not necessarily on the insurance company's list, and get their estimate, compare it against what the insurance company is recommending. Maybe talk to some of their past clients, and if you prefer your own vendor, open a dialogue with your insurer and see if you can get them to have them do the work. It's very difficult if a house has experienced a lot of smoke damage to get it back to 100%. But there are best practices and things that can be done there. Next slide. So debris removal, I think, as Linda mentioned, is one of those coverages that's typically a percentage of your overall policy limit. We see 5 to 10% being standard. As for those of you who've suffered a loss in the recent fires, as I'm sure you're aware, they're doing it this go around in 2 phases. We have the EPA handling the most toxic of the toxics, that being asbestos, lithium batteries, things of that nature, and they've just gone in and started. The trucks are out, the dump sites have been designated, and that work is underway. The next phase is what I call the opt-in for the Army Corps of Engineers, and the deadline to sign up for that is coming up in March. So as you can imagine, we're getting a lot of phone calls about whether folks should opt in or opt out. And the advantage of the Army Corps of Engineers, as anybody who's been affected probably knows, is that they are going to be looking to your insurance to get reimbursed. But if the debris removal costs more than your insurance, they're not going to look to you for any excess. The flip side to that is the Army Corps of Engineers is a government agency. It's a bureaucracy. You're not going to have the same sort of control and that you might with a private contractor. Everybody's situation is going to be different and unique, but in general, what I'm telling folks is that they should think about getting an estimate from a private contractor. If that estimate is 2 times, 3 times your available coverage, then I think as a practical matter, you're probably going to go with the Army Corps of Engineers. And the other thing that you should keep in mind is if you have a private company do the work and they make a mistake or there's some runoff into your neighbor, if you're working with a private company, they might be more willing to make claims and complaints. Whereas if, an entire neighborhood is doing the Army Corps of Engineers, just as a practical matter, there might be less pushback there. So unfortunately, only time's going to tell, but I think it's important for folks to know what their options are and have an understanding of what the pros and cons here. The other thing on this slide is landscaping. Again, typically a coverage that's going to be in your policy based on a percentage. And this is going to include trees, shrubs, lawns, things of that nature. One issue that has come up in past fires and is coming up, especially for people that lost everything in these fires, is that they don't have a good record of what was there. Maybe they bought the house with the landscaping already installed, so they don't have any receipts. They don't remember what the Latin name is for the particular hedge they had. One tool that we've used successfully is, I'm sure we're all familiar with Google Maps. And if you're on a relatively major street or avenue, hopefully Google has come by pre-fire and has a nice color photograph of everything you had, at least on the front of your house. Another client of mine pointed out that Zillow and some of these real estate services are taking satellite photographs. And again, not of every house, I'm told, but if you're lucky, there'll be a nice aerial photograph that'll show not only the front of your house, but any other landscaping. And that can be a very powerful tool when you're meeting with your insurer after a fire loss. If you are buying a property that has some unique landscaping, on the front end, you may want to talk to your agent and broker about getting some additional coverage if you don't think a flat percentage is going to be sufficient. And Linda, I think we're back to you.
Yeah, I'll do the bottom of this. These are infrequent policy limit situations. Particularly in this state, there are very few policies or what are known as agreed value policies. This is where you get together with your insurer, particularly if you may have a high-end property and you agree with them. You get somebody out to value it. Usually the insured has to pay for it. But in the event there's a loss, there's a stated agreed value on the policy, and that's what you get for the destruction of the house, and it can extend to personal property, etc. if you have such a policy, it will say that it's the agreed value. There's also something known as guaranteed replacement cost policies. Basically, this is what I had in 91. I have not seen any insurer selling them, but if by some reason you got one as defined in the California Insurance Code, you get the guaranteed cost to replace your house, other structures, irrespective of the limits stated on the policies. In the time that I lost my house, there were these endorsements, they cost between $8 to $16. And basically, most people in the Oakland Hills had them. And so even though I thought my limits were adequate, because of, building on a slope, dealing with surge pricing, etc., they were also inadequate, and I got the full cost to rebuild my property. Next slide, please. One of the things we talked about is dealing with other or appurtenant structures. These are decks, gazebos, barns, pools, etc., set apart from the dwelling by clear space or only connected by a fence. What can be tricky sometimes is how they're defined within a policy. One insurer under one of their policy forms wants an other structure to have a roof, which is kind of an interesting thought. But you're going to have to look at the definitions on these. And if you have significant other structures, like for instance, basically some sort of a gazebo or a large swimming pool or a tennis court, or even sort of a mother-in-law unit or a cottage on your property, you may not want to go with the typical 10%. You may want to get an enhanced coverage on that to more correctly respond to the actual cost of rebuilding that. Personal property contents. This can vary between, like I said, as low as 40% to up to 100% of your coverage A dwelling limit. Also, if you have items of particular value like jewelry, you may want to schedule those. One of the things that happens with insurers is they have different lines of homeowners policies or different levels. So, for instance, I'm also was a consultant to the PG&E Fire Victim Settlement Trust. And this covered the North Bay Fire, and it also covered the Butte Fire, but for purposes of discussion, the North Bay Fire and the Paradise and Camp Fire. The types of policies that were sold in the North Bay had all of these bells and whistles, and everybody had that you saw had replacement costs, extended or enhanced replacement cost of 50%, and their contents limits were 50, 75 or more. The policies that were predominantly sold in Paradise Camp area were much lower level. And many people had only actual cash value policies, so there was no replacement cost there. And they did not have extended replacement costs. Their contents could be much lower, and the limits were much lower. And there was usually much more of a differential between the cost of replacing things and the stated limits. And as a practical matter, the overall, in the Camp Paradise area, you had lots of retirees living up there, and you had people that had very limited funds. So premium for their insurance coverage was a very significant factor. And as a result, unfortunately, they had lower in policies, and lower in benefits. Now, with the PG&E Fire Victim Fund, a lot of that shortfall was made up by the fund itself. Next slide. Oh, when we don't have to change the slide. Our commissioner has said that basically, or basically requested that the insurers advance 30% of the contents limits without seeking a inventory. And I think almost all the insurers will abide by that, to my knowledge. And it's up to a max, I think, of 250,000. In the past, this is not a unique idea, by the way. In the past, for the North Bay and for the Camp Paradise fires, this percentage got upped over a period of time. And depending on what the contents look like, it may be possible to convince the insurer to just pay the full limits, because it's going to become obvious, particularly for certain people in their property, that they're going to go over limits anyway. Something we refer to as limiting out. One of the other important parts of your policy is loss of use or additional living expenses when you have to take up temporary residence. As we've discussed before, it's usually some percentage of the dwelling limits. It may be limited by time, by statute now in California. If you're in a wildfire, you have 3 years, and you can request more time if it's taking a longer period of time to rebuild or replace your residence. And if your house has been a total loss, again, under that same declaration from the Department of Insurance, you're supposed to be paid 4 months of additional living expense at a time. Next slide, please. There are generally 2 methods of computing additional living expense for the time you live outside the house. All policies that I've seen have option that where you explain your additional expenses you're incurring, and that would be rental of temporary quarters, additional cost of commuting, eating out more because you don't have adequate kitchen facilities. Some policies also allow you to have the fair rental value of your former home. If you have this option, I strongly advise you use that, because it is much easier to deal with, and you usually get a higher recovery. You go to your friendly real estate agent and get a nice valuation of what your former home would have rented for. There's a third part to this, and if a portion of the home was rented out, the policy will also reimburse you for the loss of the rental income. Keep in mind, these all come out of, if you have a stated dollar limit, this all comes out of the stated dollar limit. And even though you may have 3 years to use that sum, the fact that you have a longer period of time does not increase the limit that's stated in the policy. We've already talked about extended and enhanced replacement costs. limits, and I don't think we need to go over that any longer or again. But if there's questions, we'll answer them at the end. Life of a residential insurance claim. Next slide, please. When an insured home is lost, the insurer typically advances money for personal property and additional living expenses almost immediately. And these are monies that go directly to you. You don't share this with the insurer. You do not share basically personal property, additional living expenses, or what we call landscaping, the insurers called trees, you know, trees, shrubs, whatever. The insurer will next then determine the actual cash value of the home and other structures and issue a check in the amount of the actual cash value of the home and other structures up to the stated policy limits for these items as a max. And they may not get there, but as a max, you won't get above that. And if there is a mortgage, then there will be a check that is jointly issued to you and the bank. Next, the insurer will typically try and work on computing the cost to rebuild the home. Many times these can be low and unrealistic. You've got the cost of rebuilding the home, the other structures, whether you have enhanced or replacement cost, and also code upgrades. And again, if there's an issue with this, you will be obtaining your own contractor with that in regard to that. You have three options. Okay, we've discussed briefly. You can rebuild on your on the lot. You can rebuild on another lot. Again, I don't know anybody who's done that, but okay. This is by statute in the state of California, or you can buy a replacement home. If you elect to buy a replacement home, then you can use up to the full cost of replacing your former home on the lot. That is your max, what it would cost to rebuild your former home. And basically that can be applied to buying a replacement home elsewhere for people that decide to do that. Obviously, it's a very personal decision. Given the enormity of this loss, the fact there are only limited resources, tradespeople, and machinery available, it will take a substantial period of time to rebuild in the area. And if you're rebuilding it, unless you happen to already have a second home to stay in, you're going to be in temporary housing for a considerable period of time, and maybe several iterations of temporary housing. Next slide, and Alex, you're up.
Thank you, Linda. So the topics on this slide, I think we've touched on a little bit already. So I'll be brief because I want to leave some time at the end for questions. And I see that we already have a number of hands up on the app here. But just to go over item 4. Linda spoke about if you have a bank that's got a mortgage, what's going to happen with the repair checks is they're going to be made out to you and the bank. So in other words, you can't deposit the check without the bank, literally endorsing it. So you're going to, as Linda described, you're going to be in this relationship with your bank, whether you like it or not, in terms of the rebuilding process. Most of the problems that I've seen over the years in my practice almost all come down to a lack of communication. Before you sign a contract with the contractor, before you shake somebody's hand and say, yes, I'll pay you $100,000. You need to get the bank's buy-in, and they'll have someone at the bank, who will be your liaison. And most banks, especially those with a large presence in California, know how to do this. They're not new to it, but you want to get their buy-in on the front end before someone starts work, and make sure the bank is on board with the contract before you sign, as opposed to afterwards. You will always have the option during the process, if you want to spend more than the insurer is offering, you can do that. But again, keep the lines of communication open with the bank so there's no tears at the end, and hopefully you can avoid calling Linda or myself. On item number 5, there is a product, or an additional coverage grant called Inflation Guard. So if you set your limits, 5, 10, 15, 20 years ago or more, you may be entitled to this. Your broker or agent should, and I emphasize the word should, tell you about that, but it may be buried in your policy, may not be something that obviously jumps out at you. But if you haven't updated your limits in quite some time, this can be, maybe just a few extra percentages, but that can translate into thousands, tens of thousands, maybe even hundreds of thousands of dollars, depending on how large a home you have. Last item is the debris removal, and I think we already covered that. So Linda, why don't I throw it back to you so we can have some questions at the end here.
Next slide. We've talked about, immediately after the loss, you're going to be staying in temporary quarters, and you're going to want to, basically, as soon as you can, find rent, like another home or apartment for a longer period of time. Immediately after the loss of my home, I stayed with relatives. But you can only do that for so long. So you will rent something. The other thing is the insured and the insurer will be dealing with the insured's contents loss. I've seen a lot of discussions about how to, what to do with an inventory and one thing another. My advice is start out by asking the insurer what they want in terms of an inventory and how to handle certain items. Most insurers do not want to see you, try and detail the 5 toothbrushes or whatever. They would like to hear something about your toiletries was X. And your professional wardrobe was X. You had certain sporting equipment. Before you go down the line and spend a lot of time on something the insurer does not want and does not know what to deal with, please try and work with your adjuster to figure out what you can do to satisfy them. Also, some insurers want you to put things into some Excel spreadsheet. And for whatever reason, they think they can get away with telling you that that's the only way they will accept it. If you can manage to do that, you will save yourself a lot of grief. Otherwise, you may need to write a pithy letter or whatever and say, look, I don't know how to do that, or I can't do that, it's not convenient, whatever. By the way, all my computer equipment were burned up, etc. But you will, that is one thing to do. If you are unable immediately after the fire to come up with contents that will hit your limits, even normally they pay for contents on an actual cash value basis. If you do not limit out, as we call it, Then as you go down the line, they will pay you, say, $1,000. You know, your sofa cost you $2,000, but it was a used sofa now, so they're gonna give you $1,000. But then you go out, eventually you have your house, now you buy a new sofa, and that's your replacement sofa, and it costs $3,000. You would then basically turn in the receipt, and the insurer will write you a check for $2,000. Because this is a laborious process, many insurers will try and find a way, if they can, to assist you in getting to your contents limits so that they and you do not have to go through the agony of doing this. There's usually a limitation period set forth in the policy. I think you get a minimum by statute of 2 years, but when you're hit, first of all, the insurer is supposed to tell you you're getting to the, this is your limitation. You can write and ask for an extension, and in my experience, they will always grant it. If your house is not completed, where are you going to put things? Are you going to rent a storage unit? I mean, it just doesn't make a lot of sense. So most insurers will accede to these sort of requests. Next slide. And this will be our last slide before we get to questions. Some of you will be or have condominium. With respect to a condominium, the association has insurance on the shell. You have to have your own insurance on any upgrades or additions you've done in your condominium, as well as your contents and your additional living expense in order for those items to be covered. So you need to make sure that you have your own individual condominium insurance. Similarly, if you are a renter, and I'll say this now, most people do not buy renter's insurance. But if you are a renter and you have some high-end items, you are going to want to get coverage for your contents in this rental property. You may also want liability insurance too, but that's not really what we're dealing here. And you will want to basically deal with, if you can get it, some sort of temporary housing, like an additional living expense coverage. Most renters simply get contents coverage if they get anything. If you have a mobile home or are living in a mobile home, if you are living in a mobile home that's being provided as part of a mobile home park, again, it's going to be akin to a condominium. You're renting the mobile home, the park itself will insure basically the mobile home, but you will want to insure your contents and additional living expense in case problem. Mobile home parks are particularly susceptible in a wildfire situation because they take a long period of time to get cleaned up, and there can be supply side problems, so where you can't get replacement mobile homes. So you may find that people are outside of their mobile home or a mobile home for quite a period of time. On the other hand, they may be able to go elsewhere and relocate to another mobile home park situation. One of my least favorites coverages ever is forced place coverage. With respect, if you have a mortgage and your insurance gets canceled, either because your insurer has decided they no longer wish to insure you, or you failed for whatever reason to pay premiums, then pursuant to your mortgage, in California, I say that because there's 10 states that have outlawed fourth place coverage, at least 10, I think now. The mortgage company will buy fourth place coverage, what it's called. This is very expensive for what you get, and typically the only coverage you get is for the structure, because that is what the insurer wants, they want to cover their security. So there will be no contents, no additional living expense. You should seek to avoid this at all costs. Then other claims issues. One is a co-insurance penalty. This is rare frankly, in homeowners insurance. This is where somebody basically elects to underinsure their property. And in that event, you've decided the worst you're ever going to have is a kitchen fire, and you go to your broker, the insurance agent, he says, yeah, don't worry about this other stuff. So you have $1 million home to rebuild, and it's insured for $100,000. But unfortunately, that idea was wrong-headed. So the house is wiped out. You were significantly underinsured. But with co-insurance penalties, the pain has only begun, because you only insured to 10% of the value of the property. Therefore, the maximum you can get is 10% of your limits. So you have $100,000, you should have insured for $1 million. So the max you could get in that scenario would be $10,000, irrespective of the fact that your limits are $100,000. Like I said, this is rare, and in particular because insurers are usually involved in setting your limits. They would have to look in the mirror if you're underinsured. So I almost never see something like this. This usually comes up mostly in commercial situations. And it can come up with respect to business income losses, where you're grossly underinsured for what a business income loss might be. Something that is very common, though, is failure to report a significant remodel or addition to the house. Basically, the insurer is entitled to assume, after everybody sets the limits and you told them what you were insuring, that you will tell them, and it tells you in your policy, that you have to tell them if you increase the value of the property by more than $5,000 or 10%. Now, if you go and remodel your kitchen and you increase, you put in higher end appliances, yeah, it'll be, there may be an increase in value of more than 5,000, but that's considered by insurers to be like normal maintenance. If, on the other hand, you do what one of my clients did, and you double the size of your house, the square footage, without telling the insurer will pay for the original square footage that you insured with them. They will not pay for the additional square footage. I had a client that had like a 5,000 square foot home. They put another story on top, which made it 10,000. The insurer was only going to pay for the first 5,000 square feet, and the cost to rebuild that. So there was a significant delta there, and insurers can enforce those provisions. So in particular, if you're going to add square footage or do something else significant, you need to report it to your insurance company and pay a premium on it. Otherwise, if you're not paying to insure it, they're not going to pay you in the event of a loss. So at this point, I'd like to thank you for your kind attention and we should go to answering questions.
All right, so let me take a quick look at the Q&A to see what questions we have today. The first question is, can you speak about naming a revocable living trust as an additional insured, specifically whether or not adding the trust as additional insured will invalidate coverage?
I just did that. So the answer is no, it will not invalidate coverage, but basically you need to tell your insurer so that you don't have a problem in the event of a loss. So when you change your deed to, now this is homeowners coverage. This is different than title insurance. It may invalidate your title insurance on the property, depending on how that's worded. But I'm not going to address that because I don't deal with title insurance generally. But if you create a trust, you change for trust purposes, estate planning purposes, you now put the property in the name of the trust, and you so advise your insurer, they simply endorse it onto your policy at no charge. That's my understanding. That's what's happened with me.
All right, let's see. Can you discuss obtaining separate earthquake coverage?
You can obtain it separately. The issue you may have though, when you have coverages, if at all possible, you would like to have them through the same insurer and through the same agent or broker. Because in the event of a loss that spans several different coverages, you don't want everybody pointing at each other. But earthquake coverage, you may have to obtain separately, and it has high deductibles and different sorts of exclusions. It's a very specialized market. I don't know, Alex, do you have any thoughts?
Yeah, so couple thoughts on earthquake insurance in California. Typically it's not going to be mandatory under your mortgage, but of course, we live in an earthquake area, so it's certainly prudent to get it. There's a program in California that helps people upgrading, bolting their foundations to their structure. I've only most recently been involved with that last year, so things may have changed for this year, but typically they fund it to a certain amount, a whole bunch of people apply, and then when the fund runs out, that's it for this year. But especially for folks that have older homes that either aren't bolted down at all or were bolted down in the 60s with some older technologies, that can be money absolutely well spent, because whether you're with a private earthquake insurer or you go to the California program, which is CEA, there's going to be deductibles. And if your house falls off the foundation during the shaking, you're going to have a major claim, tens of thousands, if not hundreds of thousands of dollars in damages. On the other hand, if your house stays attached to the foundation, you may have cracking and other damage, but it's going to be of a much lesser magnitude. In terms of the insurance itself, the California CEA program is essentially the insurer of last resort for earthquakes. The coverage is not that good. It's a very high deductible, but if you want earthquake coverage and you just can't get it on the private market, I'd rather my clients have something as opposed to nothing. But as Linda mentioned, if you can get it through your existing homeowners insurer, that sometimes they have bundling deals. They might give you a discount, and certainly those deductibles tend to be more favorable than what you can get through the CEA.
Oh, right. Let's see. Is an ADU considered a separate structure, or is it an independent structure in the same policy, or should it be under another policy?
It is considered a separate structure. And I wouldn't advise putting it under a separate policy. I would want it to get it insured as an other structure on the same policy. So that would be my preference. Alex, your thoughts?
Yeah, I mean, unless your agent or broker says that you can't add it to your existing policy, I agree with Linda. I don't see that there's any advantage to having a separate policy unless you're running up against limits or something of that nature. But ADUs, especially now that they're being more favorably dealt with under California regulations to try and deal with our housing crisis. I think it's hard enough to have one insurer and pay the premiums on time with one policy. I wouldn't want to be getting into multiple policies unless you have to, or your broker says that there's some sort of advantage to doing it that way.
Okay.
All right. The next question is, are the property taxes reassessed once you rebuild?
Well, okay. What most cities, counties do is they have kind of a sort of like they give you this option is you can keep your property tax basis as long as you do not exceed an increase in the square footage of the house or the property by more than 10%. And that's done for a couple of reasons. One, they're trying to encourage you to rebuild. No, I mean, when you lose the home, you go in and get it reassessed because you don't want to be paying property tax on something that isn't there. So you would get it reassessed to a land value. They're looking forward to getting those property taxes back. So they want to encourage you to do that. You rebuild it, and you can keep your basis. This is what's commonly done, as long as you don't increase it by more than 10%. If you do go beyond that, then most likely you will be reassessed. And one of the reasons for the 10% cutoff is they're trying to also at the same time keep the character of the neighborhood. If you look at my firestorm, the one I shared with about 3,300 other homeowners, and you would go back up to the Oakland Hills, they did not have this situation. And so you see, it looks nothing like what it did before. There aren't a bunch of small little, first of all, nobody was allowed to build another brown shingle, we look to the codes change, everybody, almost everything's stucco. Everybody has a Class A fire roof. And so, but they also are built all of these homes are much built larger than they were then. And I think based upon that, a lot of the county, city, whatever, that go through these firestorms, they really want to keep the character of the neighborhoods that were there before.
Oh, right. So we have a few attendees asking you to discuss the CA Fair Plan coverage. Do you have any thoughts on it?
Yeah. If you have no choice, then you get it. It's not generally as good a coverage as you could get regularly. The reason it is the coverage of last resort. The other thing is you have to be careful with it. It doesn't offer as much for contents. Sometimes you get it and there's no additional living expense. So you have to think about and see if you can get as much coverage as possible through them. And generally, they do not have extended or enhanced replacement costs. I know it's not really helpful for me to say you want to avoid it. If you don't have a choice, you don't have a choice. So you have to go out and get it. And you would rather do that than have your mortgage company do forced place coverage. Those are my thoughts. Alex?
Yeah, so top, Linda hit on the highlights, but for a lot of my clients, it's the limits of the FAIR plan that are really problematic. It's 3 million for residential and 20 million for commercial. So if you have a $50 million commercial building, it's almost a non-starter. And if you have a very large home, 3 million may be problematic. A lot of my clients face the choice of getting what's called surplus lines insurance, which means an out-of-state insurer. Those policies tend to be a lot more expensive than the California admitted policies, where the rates have to be approved by Commissioner Lara. But some folks are just facing a really difficult decision. Do they pay almost double the premium with an out-of-state insurer, but have all the bells and whistles that Linda just enumerated, or do they go with the FAIR plan? What I tell my clients is if you have to do the FAIR plan for one particular year, while we're in this, what can only be described as an insurance crisis, it's meant to be a temporary stopgap, right? It's the insurer of last resort. I would, if you have to go on it, I would certainly recommend trying to get off of it as soon as you can. And whether you want to look every year or every 6 months, maybe your insurance broker, your agent is a brother or a cousin or something. Talk to somebody else behind their back and get some alternatives. But the FAIR plan is it's a stopgap measure at best, and you want to explore. But at the end of the day, if your choice, if you don't have a mortgage, if your choice is to have no insurance and go bare or FAIR plan, obviously do the FAIR plan. Better to have some insurance than none.
Oh, great. And then let's see. Can you please discuss options if an HOA community did not buy sufficient insurance for their community? So people are having loans denied, not meeting coverage for existing loans, and failed to obtain a renewal.
Can you go over that question again?
Yes.
I'm sorry.
So this attendee is asking you to discuss options if an HOA community did not buy sufficient insurance for their community, which resulted in people having loans denied, not meeting coverage for existing loans, and failing to obtain a renewal.
Yeah, that is a difficult one because they can't go out and independently get their own, in a condominium situation, you can't independently get your own coverage for the shelf that you're living in. That has to be done by the homeowners association. And you can sue them. Presumably they have some sort of errors and omissions coverage, but none of this is really an acceptable solution to inadequate coverage. And I'm not sure, other than suing the homeowners association, which they're also part of, how you can rectify that situation. And I've never dealt with a situation where banks are, basically balking at the situation. Usually, when you buy into a condominium association, the bank is looking at the insurance and supposedly separately assessing that they think it's adequate to secure the loan. Alex, do you have any thoughts on this?
Yeah, no, I mean, it sounds like that you've got a more of an HOA question than an insurance question. And you're probably going to have to look at your actual HOA agreement and see what it says and how are disputes supposed to be resolved. There might be, I've seen requirements in several HOA agreements that require mediation or arbitration, that you have to make a demand first. So if it sounds like this is in the context of issues happening before a loss, which is good. You don't want to find out you're underinsured after a loss. But I'm afraid you're probably going to have to talk to an HOA lawyer, and that's a little bit outside of my expertise. But if you want to contact us offline, we both Linda and I know some good HOA lawyers. We can certainly put you in touch.
Okay. Agreed.
All right. The next question is, can ordinance coverage be added to structure coverage if you buy a replacement home rather than rebuild?
Yes, by statute. However, a lot of adjusters are either not familiar with the California statute, and a number of them you're going to have when you have a catastrophic loss are going to come in from out of state. And so there's a couple of things they will go through. I've already heard and had to educate a couple of adjusters that, oh no, you don't get to apply your code upgrade coverage to a replacement home. Yes, you do. It's by statute. It's spelled out in the statute we cited. The other problem, and the reason why the statute was enacted, these are policies that are sold across the United States. They typically, if you look at them, require you to rebuild a home on the lot, okay? In 91, when I lost my house in the firestorm, I decided as I was leaving, I was never going back there. It was scary, and I wasn't going to take 2 small children back there. So found a replacement home nearby, and I asked them I said, look, you can pay to rebuild my home on the lot, but I don't really want to go back there. There can be unforeseen costs of reconstruction, like all this coverage. I'm going to be out of my house longer and you're going to have to pay for it. So can I take that money and buy a replacement home? They went, well, doesn't say that. But in about an hour later, I got a call back and I got the approval and we did that. One of the big issues that came up at that time and came up repeatedly before the statute was enacted was that you go out to buy a replacement home. Well, you're not just buying a home, it exists on a lot. So the insurers wanted to, you have $1 million to rebuild your home, and you went out and spent, $1 million on your replacement home, but in reality, 50% of that was the lot. So the max you can get, because you have to spend your replacement monies in order to get them, was $500,000. So this went back and forth and fighting back and forth. So we have this statute. the insurers cannot deduct for the value of the land in the new home that you're going to buy, that you get the full cost, but it's a max. You get the full cost up to your limits on the policy, for your former home. And you can apply that to purchasing a new home without any deduction. You get the enhanced replacement cost, you get other structures, you get code upgrade. Okay. You will also have to deal with your mortgage company, which usually means, paying off your loan and getting a new loan on your new property. That will then leave you with your lot where your former house was, and at some point you can either rebuild there or you can go and sell it at some point in the future. So that is now how that works. But again, when you're dealing with adjusters, this is unique to California. Some of them are not aware of it. And also, intellectually, they have problems with the fact that, hey, what do you mean code upgrades? You're not paying anything to upgrade a house that you're relocating to. Why do you get that? You get it because it's set forth in the statute.
All right. The next question is regarding code upgrades. Do those apply to standing homes damaged by the fire or only total loss?
They also apply to the extent you have to repair the property, and that involves complying with code upgrades, then it also would apply there. Code upgrades, though, do not apply if your house was out of compliance prior to the fire, and you now have to comply with and pay for complying with the codes that you were out of compliance with, per se. That's not what they're meant for. They're meant for, the increased cost of rebuilding to comply with newer codes. And almost all fires generate all wildfire losses will generate new thoughts about fire resiliency and new codes.
All right. And the next question is, do you advise waiting for insurance to send ACV estimates for the dwelling, or to hire a contractor, get a rebuild estimate, and send it proactively to the insurer?
This is a timing issue. The ACV, generally, for most people, the ACV is going to equal the stated limits on the house. What you're going to get into an issue potentially is on the replacement cost issue. Because if they pay the ACV, even if it's below the limits, they've got to figure out the replacement cost, which is going to be above whatever the ACV is going to be. So at some point, you're going to get that money, and it's generally, it doesn't make sense to dispute ACV limits. And with respect to a replacement cost, they may come up with a replacement cost that maxes out your replacement cost limits, your extended limits, your code upgrades, and all of that. So there's no need in my mind to run out and get a contractor to dispute that proactively, because you may end up on the upside of that anyway. And you're going to have to pay the contractor to do that. So I wouldn't do that if it were me. Alex?
Yeah, I agree with everything that Linda said, which is essentially for the, I think the majority of people that lost their homes entirely and foundation damage, etc., you're probably going to max out on your limits, regardless. So it's not going to hurt to get a private contractor estimate, but it may not be necessary. One of the problems we have in any of these mass fire events is it's going to be hard to find a contractor. It's going to be hard to find lumber, and lumber is going to be expensive, etc. So if you had a policy with very high limits and you have partial damage and you think you're going to be coming in within limits, then you might want to be thinking about getting ahead of the game and finding, a open quote good contractor, one of becomes highly recommended. But I think for most people, I think you can wait. And once you get the numbers in, if it turns out you're going to max out no matter what you do, then you can avoid that expense and the time.
Great. The next question is, let's see. Is it not true that if the homeowner decides not to rebuild, they will only receive the actual cash value and not the full dwelling limit on the declaration page? The insurer will withhold recoverable depreciation, which it will pay to the homeowner only after certificate of occupancy is issued. Therefore, a homeowner who decides not to rebuild will receive less than the full amount insured for.
Okay, in order to get replacement costs on the home, you have to actually replace. There's 3 ways. I mean, you have to rebuild either on that lot or another lot or buy a replacement home. Otherwise, all you will get is the actual cash value as stated in the policy. Having said that, for a number of homeowners, I've negotiated a policy buyout in excess of the actual cash value. So, most of what I do for a living is I'm a negotiator. Not that we can litigate, but usually a lot of matters can be resolved through negotiating. And so technically, it's correct. You would only get the actual cash value if you were not going to replace the home.
And if I could just follow what Linda just said there, especially in the commercial context, I've had clients in the past who a building of theirs burns down and they've got partners, shareholders, boards of directors, etc. And long story short, they don't know if they're going to rebuild or not. It may depend on finances next year, our interest rates going up or down. So what I tell folks is, you don't have to make that decision right away. You're not obligated to tell the insurer one way or the other. And as Linda correctly points out, on more than one occasion, in fact, I'd say it's almost standard, the insurance company may just pay you out as if you're going to rebuild, because they want to close the file and get rid of the administrative hassle of monitoring your claim. But you can't, there's no way under the statutes to essentially force the insurer to do that. But just as a practical matter, that happens all the time. So, and you also want to reserve your right to change your mind. So you may decide this week, I've had it with Pacific Palisades, I'm moving to some other state, and 6 months from now, you may decide some other state isn't what it was cracked up to be. I want to rebuild, and you have that right. So I don't think it's appropriate for the insurer to force you to make that decision, especially now when we're almost everybody is going to be in the demolition and debris phase. You've got time to make these decisions, and I wouldn't rush to make them, because the minute you tell your insurer we're definitely not rebuilding, we just want ACV, they're going to write you a check and close the file out. You don't want to do that.
My advice is to, even if you don't believe this, to keep your option open by saying you are seriously considering rebuilding. And I have had clients, basically, I've been negotiating their rebuilding costs, one thing and another, and suddenly something has happened and they've decided they want to buy a replacement home. And the good news for the insurer is that cuts off your additional living expense. So you have a wedge there. You're going to be able to give them something if they help facilitate your buying your replacement home.
Oh, great. So we'll take one last question. We have an attendee that would like you to speak to the implications of Section 8558 of the California Government Code, if you had any thoughts on that.
Without it in front of me, I don't know what it is. To be honest with you.
What's the number again?
8558. It establishes and it defines local emergency, establishes 3 degrees of emergency. But we could circle back to them offline as well.
Well, no, that's right. So I think so. A state of emergency for these fires has been declared, and so that triggers certain statutory percentages of payments that have to be made, etc. And Linda, I think the particular question is the various degrees, which you might have, since you were involved in the Paradise and the other North Bay fires, you might have more intel on that.
In those instances, in my experiences, when you have these wildfires, they're all at the highest level. They trigger all of the bells and whistles and extensions you get in the insurance code. I haven't seen anything declared at a lower level. So once again, I want to thank everybody for their kind attention, and we will we will try and answer some of the remaining questions offline.
I just wanted to take a moment to thank you both for your time today. We truly appreciate you putting together this informative presentation, and I hope everyone enjoys the rest of their day. Thank you.